The point of all this is that nobody knows exactly what's going to happen in the future. Everybody wants certainty, but certainty is not on offer. The point of that soliloquy is that anybody who doesn't own some gold and some silver in their portfolio is a person who necessarily believes, as an example, that the government is on their side. I don't think that's prudent. Anybody who thinks that there is a prudent case for investing in physical gold and silver should consider, with funds where they can stomach volatility and some risk, owning the gold and silver stocks.
Precious metals like gold and silver in particular tend to move independently of other assets, such as stocks. They can help individuals maintain a store of value during periods of inflation. Rick Rule, the founder of Rule Investment Media, believes that people must include gold and silver in their investment portfolios due to the unique qualities of these metals. A united U.S. Federal Reserve agreed to hold interest rates steady at the June meeting to buy time and assess whether further rate hikes would be needed. Even as the vast bulk expected, they would eventually need to tighten policy further. Rule believes that the pause in interest rates by the Federal Reserve could result in two possible outcomes. The first is that the current actions effectively control inflation by increasing interest rates, which would encourage saving and slow down economic activity. The alternative scenario is similar to the situation in 1975, when the Federal Reserve initially succeeded in controlling inflation but later changed its approach, leading to unexpected consequences such as fluctuation in the price of gold. Gold prices on Friday were on track for a fourth consecutive weekly loss, as investors bet the Federal Reserve will keep interest rates higher for longer, weighing on non-yielding bullion. In a recent interview, Rule highlighted that when the Fed raised interest rates, the price of gold experienced a rapid decline. Within 9 or 10 months, it dropped from $200 per ounce to $100 per ounce, representing a 50% decrease. This decline caused many newly entered investors to lose faith in the market. However, when the Fed changed its strategy and reversed course, the price of gold began to climb again. This demonstrates the significant impact shifts in interest rates and monetary policy can have on assets like gold. Rule believes that the precious metal sector will undergo a period of relative weakness in the next 3 months. The precious metal sector of the commodities market led the way on the downside in Q2 2023. While the overall asset class edged 0.21% higher, the average performance of precious metals declined 8.34%, with palladium leading the way lower with a double-digit percentage loss. Gold was the best-performing precious metal, but it dropped by over 2% for the 3 months ending on June 30th, 2023. Now, watch excerpts from Rick Rule's interview with Wall Street Silver. Before we get started, make sure to smash that subscribe button and remember to enable post notifications to stay updated on our latest uploads. Thank you, and enjoy the video.
One scenario is that what the Fed is doing works, that increasing interest rates brings down the level of economic activity to the extent that they engineer a real interest rate, which is to say that, at least by conventional measures, the inflationary numbers are less than the yield available in savings products. In that case, people have a very, very, very long wait. The other alternative is that we're looking at 1975 again, for those of your listeners who aren't quite as ancient as I. In 1975, concerned about inflation, the Fed raised interest rates very aggressively and appeared to be getting away with it for a while. When the impact of those higher interest rates was felt, particularly in the bond market, but also in the equities market, and then in the housing market, the Fed lost its nerve and had what's now referred to as a pivot. Mm-hmm. And the consequence of that is, and I think it's important to go over the history in terms of the gold price. In the period 1970 to 1975, before this period of rising interest rates, the gold price had risen from an admittedly price-controlled low of $35 an ounce to $200 an ounce. That six-fold move in 5 years got a lot of attention. Mm-hmm. When the Fed raised interest rate, the gold price fell in 9 or 10 short months from $200 an ounce to $100 an ounce, a 50% decline. And that 50% decline shook out a lot of the new supposedly faithful. When the Fed had to pivot, gold went on a truly epic run. Went from about $100 an ounce to, if my memory serves me correctly, $850 an ounce. And it did
Wow.
that in 6 short years. I see precious metals, at least for the next 3 months, being fairly soft. I'm amazed by the apparent strength in the U.S. economy. Make no mistake, I've been through rising interest rates before, and sometimes the impact of rising interest rates, the negative impacts, lag. But I am amazed at the relative strength of the U.S. economy. I think as a consequence of that the Fed can and likely will engineer at least 2 more 25 basis point rate increases. The near-term impact of that is that other forms of savings and investment assets become more attractive, relatively more attractive than gold and silver. I would point out to your listeners that when I say relatively, I mean just relatively.
Yeah.
The truth is that the nominal interest rate that you receive on your savings products, even with 2 more 25 basis point rate increases, still means that your savings yield is less than the destruction of your purchasing power.
Yeah, that's not good.
But you asked me the question. The truth is that in the near term, perception is more important than reality. And the perception about the land is that all is good, that the big thinkers have once again saved us from ourselves, that the Fed is engineering a soft landing. And I think the consequence of that is that faith in conventional savings instruments and faith in the US dollar will continue strong to the detriment of gold and silver. I happen to believe the underlying premise is wrong, but it doesn't much matter what I think. I don't make a market. The consequence of that is that I continue to make systematic purchases of gold and silver for my own account, and I continue to build on my existing inventory of gold and silver stocks.
Silver is often considered a relatively safe investment, but its value tends to fluctuate more than that of gold. However, Rule sees silver equities as highly volatile financial assets, and he stresses that the appropriate level of exposure to silver depends on an individual's financial means and their willingness to take risks. Speculators who have a good understanding of and can handle the ups and downs, as well as the associated risks, should be able to see the potential for gains in silver equities. In the last year, silver prices have gone as low as $17 an ounce to nearly $26 an ounce. Over the last decade, silver has vacillated even more. Its lowest price was just under $14 per ounce, while it cost almost $28 per ounce at its peak. That's a peak-to-trough difference of 101%. Let's get back to the interview.
People whose means and whose willingness to work enable them to speculate might want to take, as I do, their exposure further. The metals equities, but in particular the silver equities, are as volatile a financial asset as I've ever seen in my life. Speculating on possibilities or probabilities and the level of exposure that you have really depends on your means and your tolerance for risk. There is no saver, in the U.S. market that I think can regard themselves as being safe if they don't have at least a small component of physical precious metals exposure in their portfolio. No contrarian investor that I think should have an equities portfolio that isn't exposed to natural resources and precious metals. There is no speculator that I can think of in his or her right mind that doesn't understand the speculative setup, if they can stomach the volatility and the risk, that doesn't understand the potential upside in silver equities. And I suspect that the silver equities market would bifurcate or trifurcate, meaning that the highest quality silver equities, the Wheaton Precious, the Pan American Silvers, those sort of things would move first, but their moves would be less extreme. The more responsible, more muscular juniors, the mags, the silver crests of the world would move next. And I think they would surprise people. But what really will move will be the best of the tertiary stocks. And trying to determine the best will be a real challenge for most people. Companies that have managers who are experienced in the silver business, not just experienced promoters. Companies that have deposits of a size that there's some optionality, meaning if the silver price goes up, that the deposit is large enough to attract real attention. And people where enough is known about the deposit of 43-101 at the very least, that you can construct evaluation metrics using various price points to determine optionality. Those stocks, those few stocks, I think are poised to perhaps not repeat the silver standard and Pan American moves, but certainly they're poised to give enough performance that, put crudely, they satisfy every level of greed that I possess.
The price of gold is likely to be weak in the next 3 months, but it could rise in the long term. This is because the Federal Reserve is expected to continue raising interest rates in an effort to combat inflation. Higher interest rates make gold less attractive to investors, as it does not generate any income. However, gold is still a valuable asset for investors who are looking for a store of value during periods of economic uncertainty. Do you think gold and silver are still good investments in the long term? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.